Let's talk a little bit more about earnings season because we are almost in the final stretch. We've got just about 80% of companies in the S&P 500 reporting, and we're on pace for a 5% earnings growth rate in the first quarter. Putting that in perspective, that's the biggest gain that we have seen in nearly 2 years, according to the latest numbers out from FactSet. But there still are some key names that are on tap to report, especially in the retail sector, and could potentially signal, or it will at least give us a better sense of the consumer. Joining us now, we want to bring in Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Brian, it's great to see you here. So let's start with earnings season right now, because when you take a look at that growth number I just mentioned, 5% earnings growth, the best that we have seen in nearly 2 years. What does that then tell us just about some of that momentum maybe that we should expect to see or is shaping up to see here in the coming weeks and quarters?
Yeah, thank you for having me. And earnings season has turned out to be better than a lot of people expected. I think according to FactSet's numbers, it maybe was 3.4% expectation coming in. We're at a 5% run rate. And that's really, I think helped support the markets here, provided a bit of a floor here. But now what does it mean for the future going ahead? We have seen a divergence really continue where you have more tech companies, more cyclically oriented companies tied to manufacturing and industrials outperforming retail. When I look at, say, XLY, so consumer discretionary, how that has actually lagged the broader market. And so why is that? If the consumer has been doing the heavy lifting with growth so far, what does this tell us about the future? The market might be sending a signal that the consumer is getting a little winded here. We're seeing the screws begin to tighten, and maybe the baton is going to be passed to manufacturing, industrial, and maybe more export-oriented companies that are really hitching their wagon to the global growth recovery as opposed to just being concentrated with U.S. growth.
Brian, why is it that companies that actually post earnings surprises this earnings period are actually being rewarded less than the 5-year average here?
Yeah, that's really interesting, isn't it? And that's something that we oftentimes track is the surprises. If they beat, is it the headline number that the market is focused on? Is it the bottom line number? And when we do the analysis, it appears as though it's more driven by the guidance that they're giving about what to expect for the balance of the year or even over the longer term. So they can have a positive surprise for earnings, but that's really just telling you what they've done lately as far as for the past quarter. The real key question for markets being forward-looking is what's really coming ahead, what's through that windshield. And that's where you sometimes get positive surprises, but then coupled with a little bit of that negative guidance, and then the stocks get punished or they don't get rewarded as much as what you would otherwise think.
Brian, then what does that then tell us about valuations? Because when you have stronger earnings here, coupled with the pullback that we've seen, it makes these valuations look maybe a bit more attractive at this point. But how sustainable are these current valuations?
Yeah, so we've done some analysis here at Annex on our investment committee as far as there's a lot of people out there who look at, say, price to earnings, or they take the inverse of that, the earnings yield, and they compare it to the 10-year Treasury yield. And they say, hey, you know what? There isn't much of a gap there. The 10-year Treasury yield is really rich as far as high. The earnings yield is really low. Maybe that's a negative sign for the future. But really, if you think back to that growth story, stocks hopefully will be able to grow those earnings, whereas the coupon income you get from a Treasury, that doesn't grow. And so we think it's a fairer comparison to look at the price to earnings relative to real yield. So like on inflation protected securities, you can look at the real yield, and that gap isn't nearly as narrow as what the gap between earnings yield and nominal treasuries are. So we think that it's actually for valuations, as long as you are looking at companies that are quality, profitable, and that have that earnings runway ahead of them as far as that growth, that's where we think the better opportunities are, and the valuations are therefore more sustainable.
When you have Fed members questioning policy tightness right now and not taking off the table a potential cut entirely and for this year potentially, but then also leaving on the table a potential hike here, I mean, that's signaling a little bit more unease that the markets may have to ingest here. What do you think the reality of how the Fed is evaluating this current economic reality and environment could net out in? Do you think we'll see another hike?
Not yet. I think that we actually aren't going to see a hike until we've seen a few cuts. So at some point in the future, they will likely have to hike again, but from what level? And I think it's actually healthy to show that there is that disagreement on the Fed keeping hikes on the table. Chair Powell effectively said there's a very, very high bar in order to hike rates. Other officials have said, no, maybe that bar isn't quite as high. So really what matters is the committee decision, and Chair Powell is really at the center of that committee. So his view is probably the most important, and there's that very high bar to actually hike. We believe that inflation is going to start trending lower. The first 3 months are not a prelude to what to expect for the next 3 months for inflation. Now, of course, I could be proved wrong next week when we get the CPI number, so we'll have to wait and see on that. But so far, it does look like they would rather hold rates where they are for a longer period of time as opposed to reversing course and starting to hike again.
Yeah, CPI, next big test next week. And then, of course, we're going to have a lot more Fed speak that's still yet to come this week as well. Just, Brian, lastly, while we have you here, when you talk to your clients, if there are pullbacks and they're looking for opportunities to add into their portfolio or just hold on to cash right now, what is the strategy that you hear them employing most often?
Most often, they're actually looking at fixed income, looking for those opportunities to get these higher yields. And so one of the strategies that we really like following is when you think about the short end of the yield curve. So think about short-term investment grade. There's lots of great ETFs and mutual funds out there that you can find using the Yahoo Finance screener. So short-term investment grade or AAA CLOs, things like that on the short end. But then longer term, look at higher quality. There's nothing wrong with, say, a 10-year Treasury ETF or something along those lines to get that type of income. So on the short end, you can go for higher yield. On the long end, you can go for higher quality.
Brian Jacobsen, always great to talk to you. Thanks so much for giving us some time here and for your insight. Annex Wealth Management Chief Economist and Strategist. Thanks.